What up, Investor Nation? Ryan Herding here is back with ISC Quick Tips, and I have one of my faves to be on air with, Brian Ziegenfuse from our Capital Markets team. What's up, Brian?
Hey, how's it going?
So, man, how are you?
Good.
Sweet. So, Brian, we got a handful of questions today. We're going to start out with the first one, and it's going to be about how we evaluate markets at iFunds. So how does ISC actually look and evaluate markets?
So there's a lot that goes into the evaluation of a market. We look at what somebody's buying in that market, what somebody's building into that market, how far are they away from, job nodes or job communities, how active is that market, and how volatile that market is.
Are we using outside data sources to do it? How would a borrower go about it? They're going to evaluate a market. They're building in Philadelphia. They're going to go build the shore. How would we tell a borrower to go enter a market? What would they look at?
Some of the things we would look at, our borrower should be looking at is what's the income associated in that area. And so that's pretty easy to get at. There's a lot of, use ChatGPT or Claude, Google what the average income in that market is, and then understand, all right, when you put it out after you've built it or you bought it, what's the rent, what's the average income, and back in how much they could afford that property. And it's a pretty easy calculation. Here's a specific example. If you're in a community in which you were building a $400,000 home, you would want to make sure maybe 30, 40, 50% of the people might be able to afford that home using that adjustable income.
Love that. So they look at a Fannie Freddie average mortgage rates, right? As a good proxy to
absolutely
pricing.
That's absolutely. And so you'd want to look at current mortgage rates because they're going to typically put down, say, 15 to 20%. And based upon, so you take 15 to 20% of your purchase price, they're going to put that down as a deposit. The rest of it, they're financing. It's very easy. I would go out to Mortgage News Daily just to pull the interest rate of where it's currently at, and you come up with a payment calculation.
Love that. So borrower's a great quick tip from Brian on how to calculate, make sure you have a product that the market can afford, right? I mean, that's a big deal. All right, second question. How does capital markets ensure consistent closings?
This is great. This is one I'm actually super passionate about. When we started iFund Cities, it was super important as we were growing as a team. Ryan and I, Chris, are talking to the capital markets team on a daily basis, or the street on a daily basis. That could be leverage facilities, that could be their purchasing notes that are out in the market. And so as a culture, as we were growing as a team to go from X to Y, that the capital markets, those conversations are the capital markets teams driving those conversations on a regular basis. They're ingrained in the underwriting, they're ingrained in the sales, they're ingrained across the organization in everything that they're doing.
So, but as a borrower looking into a lender and how they select a lender, accessing those capital markets can mean a lot of things to a borrower. It could be efficient cost of capital. It could be capital that's more flexible. It could be capital that's tight, that's, but has a better cost structure to it. Help them understand how we access capital, securitizations, insurance capital. What does that mean to the borrower today?
Yeah. So you've got, I'd say, a lot of diversification in our iFund Cities capital stack. And so that's what you just mentioned is there's vehicles that are securitizable. There's vehicles that are managed accounts that are, they could be insurance. And so each one of those vehicles has different mandates, or I'd say, like, we call them an axe, like something that they're axed about, they're excited about. And so through all those conversations, we understand those different pockets, where their axes are, what they shy away from. And so somebody's like, hey, I'm comfortable with multifamily. I'm comfortable with fix-and-flip. I'm more comfortable now with new construction. And so our team staying in front of those investors and understanding where those axes are allows, and those synergies with back into the sales team, how we're structuring products. We're constantly looking at ways of tweaking our products to fit into some of those axes.
So if you're a borrower, you should be leveraged. If your lender's plugged in like we are in the capital markets flows, you got to be picking these guys' brains. Your LOs are going to have information. Your capital markets teams and these lenders are going to have information on how to access capital and what pitfalls there potentially could be with different capital sources to help you navigate your projects. Is that a fair?
100%. Yeah, we make sure, I think, Ryan, you've done the best job at this, is making sure that our capital markets team is staying connected to the sales team. And so that flow of information is being incredible to make the sales, the guys on the front line most effective and knowledgeable.
Heck yeah. We'll be back. We'll bring Brian back, aka Credit Jesus, on the next capital markets video. Thanks, Brian, for being here.
You got it.